Hello, I am Max Hines, Chief Investment Officer at Vector Capital. Over the years, I've spent my career helping manage capital at both an institutional and private level, and one trend has become increasingly clear. More investors are starting to question whether traditional wealth management is still the best way to grow and protect their wealth. Now, before we go any further, let me be clear. Traditional wealth management is not broken. In fact, for decades, it's helped millions of people build substantial wealth. The traditional approach is building diversified portfolios of stocks and bonds, and it's worked very well for a long time. But many investors today are starting to realize something. The world has changed dramatically. Technology has changed, markets have changed, the amount of information available has changed. The tools available to institutional investors have also changed. Yet many individual investors are still being offered largely the same solutions they were offered 20 or 30 years ago. Buy a diversified portfolio, stay invested, ride out the market downturns, and wait for the market to recover. But for some investors, that's perfectly fine. But for others, particularly those who have already accumulated meaningful wealth, they're beginning to ask deeper questions like, why is my portfolio entirely dependent on markets moving higher? Why am I paying someone a management fee every single year with strategies that often perform similar or worse than the broader market? Why do institutional investors have access to tools and strategies that I never really get to see? And perhaps more importantly, is there a better way? One of the realities I've learned throughout my career is that institutional investors think very differently about risk than most individual investors. Most retail investors focus almost entirely on returns. Institutional investors first focus on risk because protecting capital and managing downside is just as important or more important than generating the returns. If you lose 30, 40, 50% on a portfolio during a major downturn, it can take years before you ever recover back to where you started. That's why institutions have spent decades investing in systematic strategies, quantitative models, algorithmic execution, data-driven decision making. Not because they're trying to be clever, not because they're trying to chase trends, but because they're constantly searching for ways to improve outcomes while controlling risk. That's ultimately what attracted me to start Vector Capital. What I saw was an opportunity to bring many of those institutional principles to individual investors. A model where decisions are driven by data rather than emotion. A model where risk management plays a central role. A model where investors maintain ownership and control of their capital. A model that isn't entirely dependent on traditional buy and hold investing. And that doesn't mean traditional investing has no place. Many of our clients continue to own stocks, ETFs, have retirement accounts, real estate, other investments, but they're looking for something that complements those holdings, something that can potentially provide additional diversification, additional opportunity, and a different approach to managing their entire capital. That's exactly why investors are looking beyond traditional wealth management. Not because they're abandoning everything that they have done before, but because they're looking for additional tools that may help them achieve their financial goals more efficiently. If that resonates with you, then you're exactly the type of investor we built Vector Capital for, and I look forward to speaking with you.